Hello, everyone. I'm joined today by Howard Marks, co-founder and co-chairman of Oaktree Capital, a widely renowned and hugely respected figure in the investment industry, whose memos cut through the noise and hyper-analysis of today's busy world. Howard has dedicated much of his long and successful career to understanding and explaining the interplay between market cycles and investor psychology. We're delighted you could join us today, Howard.
Well, thank you, Sarah. It's really a pleasure to be here and to extend our work with St. James's Place Wealth Management.
That's great. Now, before we dive into exactly what is going on in the markets, I'd like to talk to you more about your approach to investing. So you've made a name for yourself as a contrarian investor, but not just a knee-jerk contrarian. You've referred to your style as smart contrarianism before. So I was wondering if you could just summarize your investment philosophy for us and how it's evolved over time.
Well, I guess the key elements in my philosophy are risk control and consistency. And risk control is very important. Basically, although it's not easy to believe at this moment, I think it's easy to make money in the markets. And, it's especially easy when the markets go up, and 7 or 8 years out of 10, the markets go up. So that's not a problem. I think the mark of the professional investor is the ability to make money with risk under control. You can make money by abandoning risk and risk control, and 7 years out of 10 or 8 years out of 10, that'll work great. In the other 2 or 3 years, not having risk control will really cause serious damage to be inflicted. I think it's important to outperform the market when the market does poorly. That's what we want to do. That's what our clients want to do, more importantly. Now, if you establish your portfolio so that you will beat the market when it does poorly, there's a decent chance that you can't beat it also when it does well. Risk control means limiting the leverage in your portfolio, the riskiness of the companies you invest in, the riskiness of the instruments, for example. And the truth is that in the good years, the highest returns often go to the person who takes the most risk. And that's not us. But I think that, our goal is I think the mark of a great investor, again, something else, is what I call asymmetry. You do better in the good years than you do badly in the bad years. So what we really try to do is have performance which is average or slightly above average in the good years. And by the way, I don't think it's important to beat the market in the good years because everybody makes a lot of money. The average is good enough. But then substantially above average in the bad years. The combination of the two will give you above average performance over the long run with below average volatility and risk. Now, that leads to consistency. And our clients want consistency. I think they come to us for consistency. And we rarely are we at the top of the performance distribution, other than maybe in the worst of times. But we're never at the bottom. And again, that's what our clients want. So, our whole life is devoted to doing these things. Now, how do you do them? You're active in less than efficient markets where not everybody knows everything, not everybody feels good about everything. We want some things they feel bad about, because that's where you get the bargains. Number 2, high degree of specialization. And each of our funds does one thing. Each of our people does one thing. It's hard to outperform if you're a jack of all trades. And then, we don't base our performance on market forecasts or macro forecasts. It's hard to do that correctly. And we're not market timers. It's hard to get in and get out and get in and get out at exactly the right time. It's better to hold throughout, maybe adjusting your aggressiveness or defensiveness with the times, and then with a portfolio that can give that asymmetry that I discussed over time. Nobody should base their approach to the market on agility. It's very hard to be agile at the right time, it's very hard to know what the right time is. And so I think that those are the elements in my philosophy. Now, you mentioned contrarianism, and contrarianism is very important. And basically what it consists of is understanding the excesses of investor psychology. And number one, not being part of them. And number two, taking advantage of them. 90% of what you have to know about market behavior, especially about short-term market behavior, is that in real life, things fluctuate between pretty good and not so hot. But in the market, investors go from flawless to hopeless and flawless to hopeless. And nothing's ever flawless and nothing's ever hopeless. And what that means simply, Sarah, is that when people think the outlook is flawless, they're too optimistic and they're going to be disappointed. So you want to turn cautious at that moment. And when people think that the outlook is hopeless, things are never hopeless. And when pessimism is overdone and people think the outlook is hopeless, it's important to turn aggressive. So we do modify our stance between aggressiveness and defensiveness, but as I said, we never get in and out of the markets. That's really just too hard to do well. Contrarianism, leaning against the excesses of psychology, is an important part of what we do.
I was wondering if you could unpack that a little bit for us, Howard, that the excesses of investor psychology, understanding them, taking advantages of the swings between, flawless to hopeless.
If you look at a chart of GDP over the years, it kind of looks like this. It fluctuates slightly, but I know the U.S. Facts best. Our GDP grows about 2%, sometimes 3, sometimes 1, rarely -1, rarely 4. So the fluctuations in the trends are modest. Now, if you look at the trend in company profits, it looks more like this. The fluctuations are more pronounced. Why is that? Companies are affected by the trends in the economy, but they have leverage. They have financial leverage and operating leverage, which means what that means is that when sales go down 2%, profits go down 20%, et cetera. So profits fluctuate considerably more than GDP. Now, if you look at a chart of the stock market, it goes like this. It fluctuates wildly. Why does if you think about it, the investing is taking an interest in companies' profits. Why do the prices of investments fluctuate so much more than company profits? The answer is psychology. And, as I said before, investors go from flawless to hopeless and hopeless to flawless. And they overdo the good news and they overdo the bad news. And so, at the extremes, if possible, you want to turn aggressive when everybody else is terrified, and you really want to turn defensive when everybody else is carefree. But those opportunities don't come along very often. We don't have profitable chances to do that very often. Most of the time, we're straight down the middle. But my second book was called Mastering the Market Cycle, and I was talking to my son about it, and I said, Andrew, I think most of my market calls have been about right. And he said, yeah, Dad, that's because you did it 5 times in 50 years. 5 times in my career, there have been chances when psychology was so crazy and prices were so high or so depressed and security prices were so low that you could really accomplish a great deal by turning hyper defensive or hyper aggressive, but normally not so.
Okay, so it sounds like the key takeaways there for our client behaviors have something to do with understanding the extremes while still taking into account their long-term objectives.
And most of the time, just staying on course for your long-term objective. Worrying about, I was asked last week, my first book was called The Most Important Thing. And an interviewer last week said to me, well, what's the least important thing for investors? And I thought for a minute, I hadn't had that question before. The least important thing is the short run. Everybody's obsessed with what is going to be inflation over the next 6 months. What will the central bank do in terms of interest rates to fight the inflation? And will the changes in interest rates produce a recession? This is what everybody wants to know. And consequently, of course, what will happen to security prices in the next 6 months? And the answer is it doesn't matter. That's not what matters. If you think those are all short-term considerations. It's all about the next 6 months, 3 months, 12 months, whatever it might be. Number one, we really can't know much about the short run. Number two, if we develop an opinion about the short run, we shouldn't have too much confidence in it. It's hard to get that right. Number three, nobody should change their portfolio wholesale in response to what they think is going to happen over the next 6 months. And number four, it's not the next 6 months isn't what matters. My clients and your clients should be investing for the next 10, 20, 30 years. And if you have a position today, what happens in the next 6 months is probably not going to affect the outcome of the next 20, 30 years. And so why does everybody care about it so much? And the answer is, it's kind of like social media. It's all around us. People are talking about it all the time. The newspapers talk about it. The talking heads on TV talk about it. And everybody gets on TV and they said, well, do you think there's going to be a recession in 6 months? No, I don't think so. Yes, I think it's bad. Yeah, not too bad, but pretty bad. This isn't what matters. And people drive themselves nuts with these matters, and they hurt their performance. Because look at the markets today. The markets are well down, and everybody's afraid about what's going to happen in the next 6 months. And if people get out today because they're concerned about what's going to happen in the next 6 months, and it's going to be very hard to decide when to get back in, because if the market goes down, it's going to be because the news is terrible. And if the news is terrible, most people are not going to have the intestinal fortitude to get back in, and they'll probably miss a rise. So you can't do that timing thing very well. You might as well abstain from trying, in my opinion, because most of your efforts are going to be counterproductive. You're going to sell because you're depressed, which means prices are depressed and things are on sale. That's not the right time to sell. And you're going to buy when you feel good. And usually your good feelings will coincide with buoyant, meaning high-priced markets. And that's not the time to buy. So steady as you go is a much better idea than in, out, in, out.
So, this concept of adhering to your philosophy and your process, irrespective of the headlines, that's a really powerful message for our clients. Now, you often reference this concept of second-level thinking. Could you unpack what exactly that means and how our clients could perhaps adopt a similar mindset?
Well, second-level thinking really is a matter of understanding that the things people are trying to do in the market. Now, you can buy and hold, and you don't even have to think. If you're a long-term investor, you're absolved of the responsibility of thinking and making these decisions on a short-term basis. Just buy a good portfolio. Hopefully, we'll help you select a good portfolio and hold it. You don't have to be a genius. But some people want to further enhance their returns by either getting in or getting out, turning aggressive, turning defensive, or selecting securities that will do better than the rest. These are active management tactics that you can adopt if you want to try it. Not easy. And kind of, I would say, embroider around the edges. The main thrust of your return is going to come from what did the markets you're invested in do in the long run, the markets and the companies. But if you want to try, so you could buy a bunch of high yield bonds today and let's say make 8%, 9%. You say, no, I'd like to try to make 10. So you can try to get in, get out, turn aggressive, defensive, or select the ones that will do better and avoid the ones that will do worse. You can try these active management measures. But to do that, you have to think at a different level than other investors. Other investors, on average, are going to make 9. If you want to make 10 instead, you have to think of something they haven't thought of. You have to know something they haven't thought of. You have to think at a level which is different and more sophisticated. By definition, not easy. And I have an English friend, Richard Oldfield, who wrote a book. I love the title, Simple But Not Easy. The things we're trying to do for our clients are simple, but they're not easy. You know, when I say get in, get out, turn aggressive, turn defensive, make superior security selections, security company selections, I'm done. It's a simple explanation of what our goal is. It's just not easy to do because everybody's trying. And this is a competitive activity, investing. You know, you're competing to have superior returns versus everybody else. So clearly you have to do something different from what other people do and something better than what other people do. So what does that mean? It sounds like it's a lot of words. The first level thinker says, this is a good company. We should buy their securities. Most people look at it and see the same thing. But the second level thinker says, it's a good company, but it's not as good as everybody thinks. So it's going to produce a disappointment. We should sell their securities, you see? And you're just thinking through to a new level. You're thinking through to the ramifications of what everybody thinks. I think that, again, it's simple to explain the goal. It's just not easy to do. But that's why there are superior and inferior investors. That's why some people have good long-term records and some people don't survive for the long term because it's not easy. But if you want to outperform, I mean, I would like each person who's listening to say to themselves, do you want to outperform or are you happy with average performance? It sounds kind of un-American, but I think in the long run, average is really good enough. And if you want to be above average, which is a reasonable goal, how will you do it? And since this is a competitive activity, you're competing against all the other investors out there, and you want to have a better record than they do on average, there has to be some advantage that you have. So I would like the listener to say, well, what is my advantage? And I think that to be a superior investor, you have to have what I call a knowledge advantage. You have to either know facts that the other person doesn't know, and that's very hard today because, you know, in our country, the SEC, the goal is to make sure that everybody has the same information. Otherwise, it's inside information, which could be illegal. So it's hard to get facts that the other person doesn't have on a given company or process them better. So the people in the audience should say, do I have some mental equipment that permits me to process the facts better? And clearly, in order to do that, you have to be an expert. Is it reasonable for me to think I'm an expert? It's great to have aspiration, but your aspiration should be based on some reality, which is, I know something the other people don't know. Is that a realistic thing to say? And if not, you should, you know, either settle for average or turn over your capital to somebody who does have a knowledge advantage for management. And that's what we try to do.
Okay, that's great, Howard. Thank you so much. Now, I think this is a good opportunity to switch tack slightly and take a look at the markets, really getting into your philosophy and understanding how you view where we're at in the current cycle. Now, you've long stressed the importance of understanding market cycles, of being able to identify where we're at in the cycle so as to tilt the odds in our favor. What is most critical to understanding the cycle and where we're at?
Well, I'm very glad that you phrased the question that way, Sarah, because you first of all, it's folly to say this is what's going to happen a year from now. At best, you should think in terms of what we call a probability distribution. This is the range of things that could happen a year from now. These are the ones that are most likely. These are the ones that are unlikely. That is to assign probabilities to different outcomes. Investing really comes down to two things: fundamentals and attitudes or psychology. Fundamentals is the things that will happen in the economy, the things that will happen in companies, sales, profits, etc. But that's fundamentals. And then attitudes. How will people view the fundamentals? What will the psychology be of the moment? So that's what we have to think about is the likely fundamental outcomes and the likely changes in psychology. And so the real question, and this is again why this job is simple but not easy. The real thing is not to say what events lie ahead. That's easy. It's certainly easy to be in the mainstream of thought in that regard. But to say what future events are already reflected in security prices. And if, as I said, if everybody knows that there's likely to be a recession within the next 24 months, then that expectation is probably already reflected in security prices. So you can't do any good by selling now. I think we're in that middle range where everybody knows that some negative events may well lie ahead. Those negative events are already anticipated in security prices, which is to say that security prices are fair, reasonable, given the outlook. That's my conclusion. When I think about the markets, I think about, are they rich, cheap, fair? If they're rich, you should turn defensive. If they're cheap, you should turn aggressive. If they're fair, steady as you go. And that's where I think we are. When I look at the market, I don't see excesses. A year and a half ago, you could say, well, these are things that look like they're riding on ebullience. Maybe tech stocks, software stocks, meme stocks, cryptocurrencies, SPACs, etc. There were things that stood out as saying, boy, those things are sure embodying a lot of optimism. People sure love those. Well, nobody loves anything today. Nothing embodies optimism or excessive optimism. And when I look at the markets, I don't see particular groups that stand out as reflecting excesses. I think we're in that middle fair territory.
And Howard, in your view, with market activity the way it is at present, are we in unprecedented times, or have we been here before?
Today we have to live with Russia and the threat of nukes in Ukraine, which sounds terrible. People say, oh, it's never been this bad. But I remember when I was a kid in school, we used to have what were called shelter drills. I don't know if you had them in the UK. You're obviously not old enough to know. But we used to get under our desks when we were in the fourth grade and put our hands over our necks to protect ourselves from atom bombs. So that was a scary time. And people used to say, it's never been this uncertain. And we've had great uncertainties over the years. And today it feels like it's the most uncertain it's ever been. But that's because we're in new territory. We have an antagonist who seems irrational, and he has nukes. But I'll bet you if you live long enough over the next 20 years, there'll be another time and people will say, oh, you know what, it's never been this uncertain. Anyway, but we have economic uncertainty. We have inflation. Well, I saw that in the 70s, and it was about twice the current rate. We have the prospect of rising interest rates. You know, I can show you here in my office, I have a slip that I got from a bank in 1980, and it says the rate on your loan is now 22.25%. So we had interest rates which were much higher than today. We've had some very serious recessions in the past. We've had geopolitical uncertainty, political uncertainty, unpopular leaders. So, you know, we can quibble about the degree, but we've seen stuff like this. We've had themes that rhymed in the past, and we've seen markets go up and down. But I think that what I want to say to your audience is this. Go back to 1920. In the last 102 years, the US, for example, just an example, has had 17 recessions, one Great Depression, several small wars, 2 world wars, well, I guess one since 1920, lots of geopolitical uncertainty, etc. And yet, on average, over the last 102 years, the S&P 500, for example, has made over 10% a year, on average. And if you invested $1 in 1920, I think you'd have $8,000 today. So the answer is there are ups and downs, there are scary things, there are thrilling things, but if you just strap yourself in and hold on for the long run, economies have positive upward trends, companies have positive upward trends, markets have positive upward trends, and if you're in for the long run, the chances are overwhelming that you will benefit from those positive trends, especially if you're a bondholder where companies have promised you 8-9% interest a year. Just hold on, receive that and enjoy it, and don't try to overcomplicate it by getting in and getting out and adjusting your portfolio.
Stick to your philosophy and stick to your process. Now, Howard, you've also mentioned in some of your memos something called the zone of reasonableness, which seems to run counter to a lot of, what we're hearing and what you've just spoken about with the news headlines. Could you walk us through exactly what that means?
Well, look, this is going on from what I've been saying, but again, the zone of reasonable is that fair territory in the middle. If you think about it, what I said 5 times in my career, or maybe it's 6 or 7, there were great opportunities when the market was either up here or down here. There were opportunities to turn defensive, to turn aggressive. I've been in this business a long time. What that means is most of the last 53 years, it was neither. We were in the zone of reasonableness, what I call fair territory, where the smart thing to do is to hold on. And, my first book, The Most Important Thing, talked about patient opportunism. And I said in there that if there's nothing clever to do, it's a mistake to try to be clever. And most of the time in the markets, there's nothing clever to do. And that's especially true for non-professionals. The professionals rarely get it right. Non-professionals have an even lower chance of getting these timing decisions right. And that's why they should set a portfolio and leave it alone. And, when we're in the zone of reasonableness, interestingly, here's one thing for your audience to think about. I think about this all the time. Your audience should think about, they own a bunch of stocks. Do they look at the stock prices in the newspaper every day? Most do. Why? They're not going to sell them. They're not going to buy more. It doesn't do any good to see, oh, it was up 1 yesterday, it was down 1 yesterday. People do these things, I think, for, I don't want to be too judgmental, but I would say invalid reasons, inappropriate reasons. Again, set a portfolio that makes sense for your life circumstances, leave it alone. And the long-term results are overwhelmingly likely to be positive.
That's a very clear message. Thank you, Howard. Now, I'm going to switch tack a little here. How are you thinking about opportunity right now? What is there to be positive about?
Well, the main thing to be positive about is that so many people are negative. And when the market reflects so much negativity, there's not much scope for disappointment. People are unlikely to be disappointed today because they're already anticipating negative things ahead. There is some possibility that they'll be pleasantly surprised. You know, for example, one of the problems we have today is a high level of inflation. And I think there's a possibility that a good part of the factors that cause that inflation will abate. A lot of the inflation came from government's excessive stimulative measures to try to make sure that the pandemic-related shutdown wouldn't kill the global economy, and maybe they gave out too much money, and so maybe people have too many spendable dollars. And by the way, if the government gave out money in 20 or 21 as they did in America, it's important to notice that people couldn't spend those dollars. You couldn't go on a trip. You couldn't go. You couldn't throw a big wedding. You didn't even have to buy a dress for a wedding because none were taking place. So those dollars or pounds piled up in the bank. And then when the economy came back, people had pent up demand. They ran out to spend those dollars, but the industrial machinery restarted slowly, and the supply of goods was not adequate to keep up with this heightened demand. So what is inflation? It's for the most part, it can be summed up as too much money chasing too few goods, which causes prices to rise, of course. And but you know, over time, number one, the excess of dollars or pounds get spent, and they're not going to get spent again because they don't exist in bank accounts again. And the supply of goods catches up with the demand, which causes the prices to ease. So these are cyclical impacts on inflation, which I think, as I said, will abate, and I think it may come as a positive surprise to people. So, you know, everybody knows that the outlook is murky, and I agree with that. But there's some possibility that that the facts won't be as bad as the expectations, and there's some possibility that the psychological reaction of the markets will be positive because worries ease. So when you ask what could be positive, I think that's my answer.
That's great. Thank you. And a final question from me today, Howard. What kinds of conversations should our everyday investors or clients be having with their advisors at present? What is important for them to be asking and for them to be considering?
Sarah, if people subscribe to my view that what matters is the long run, not the short, they shouldn't be saying, well, do you think there'll be a recession tomorrow? Do you think there'll be inflation, et cetera? Because A, nobody knows, and B, there's nothing to do about it. And C, it doesn't matter in the short run. So what they should be talking to their advisors about is primarily, is my portfolio right for me? It's important to remember that everybody's different. So what's right for everybody is different. And the main thing is, look, we believe in the investment business that for the most part, the more risk you take, the more return you may achieve. You're not sure to achieve it. If risky assets were sure to have higher returns than safe assets, then by definition they wouldn't be risky. So that's kind of an oxymoron. But if you aspire to higher returns, you generally have to take more risk to get them. Doesn't mean you get them, it means you have a chance of getting them. Everybody should think about what is the right level of risk for them. And, you know, for people like us, individuals, Not a lot of my clients are pension funds, sovereign wealth funds, insurance companies, endowments, and so forth. But for people, in trying to figure out what is the right level of risk, what you say is, how old am I? How many years do I have to retirement or to live? How many dependents do I have? How does my wealth compare with what I'll need to get through retirement? How does my income compare to my needs? Is my income a multiple of what I need, or am I barely making it? If I make a mistake, if I live through a down cycle, do I have time to recover from that down cycle? And then importantly, so all those things are almost quantitative, but importantly, what is my attitude toward risk? What is my level of intestinal fortitude? How will I feel living with big ups and downs? Because, if you have money to invest, one of your important goals should be to be comfortable. You should not have more risk than you can healthily endure. So everybody should think about their level of risk and then have a portfolio which is in line with that level of risk. Not more, because you could have bad consequences and an unpleasant experience, and not less, maybe, because if you do, you're sub-optimizing. You're doing less than you might healthily do. So this is really, and this is hard stuff, because there's no way to put all that stuff in a formula and come out with a risk position. And then if you come out with a risk position, there's no way to put that in a formula and come out with a portfolio. All these things have to be done judgmentally by thoughtful people. But if you think about it, you say, like I look at it myself, I'm of retirement age. Fortunately, I don't have to retire. I like my work. I have more money than I need. On the other hand, I'm a conservative person, and I don't want to experience big ups and downs. And since I have more than I need, why should I take big risks to make even more? So I look at the scale. I think of a dashboard, a speedometer in a car, which goes from 0 to 100, where 0 is no risk and 100 is maximum achievable risk. I look at it, I say, well, I'm like a 70, or 75 maybe, because I can afford to lose some money in the short run. I can afford negative fluctuations, albeit I would not enjoy them. So, then I turn that into a portfolio, most of which is fixed income, dependable things that produce a steady income, which is all I need. And then, a little bit is invested aggressively to try to make more. That's the kind of dialogue that people should have internally, couples should have with each other, and people should have with their advisors. And that rather than worrying about whether there's going to be a recession in the next 12 months, I think that is time well spent.
We could not agree more here at SJP. Howard, it's been an absolute pleasure to speak with you today. Your insights, as always, are incredibly valuable. So risk control, consistency, long-termism, important tenets for us here at SJP and for all investors to be considerate of in their processes. So thank you again for joining us.
Well, thank you for having me on, Sarah, and for your good questions.
Thank you.